So I'll start by talking about the precursor to factor investing. And it's referred to, this is kind of like the first academic foray into, can we create an equation that prices in equity, essentially. So this is the capital asset pricing model. A lot of you may be familiar with this. It was introduced in the 60s by two Nobel Prize winning economists, or really three. Markowitz, who was also very famous for MPT, as well as Sharp and Miller. So what you see here is basically the argument they were trying to make with this model is that a stock that returns more than the market average will have sort of a higher risk that is associated with that. And so therefore, there is no way to explain higher average return without introducing a higher average risk. And so what that basically trying to say, so first of all, beta. So if you look at this formula, you see like the return equals sort of a constant plus B sub A. So that is beta. So beta is the measure of the risk of a stock compared to the index. So, and that's kind of like, so if you have a beta of 1, that means that if the index drops 30%, may sound familiar, that stock is expected to drop 30% approximately. And so you can definitely create an equation like this, but factor analysis sort of comes into the picture and says there are other factors besides just beta that are present in higher average returning stocks, and we can use that to predict and create a good quantitative portfolio. And feel free to interrupt me at any time if you have questions. I definitely want to make this very interactive. If I'm going too fast, going too slow. So if you believe this, what you would believe is that there's really no benefit to buying a stock that's outperforming or that will likely outperform, because you're going to have a higher associated risk with buying that stock. So like, let's say you think that Google is going to go up more than the average. If you were to believe this equation, you still wouldn't buy it. It wouldn't be any better than buying a stock that would go up the average amount, but you could sort of borrow money and sort of buy that other stock. And so basically, the risk return profile will be exactly the same in either way. So this is where in the 90s, Fama, who's like another very famous Nobel Prize winning economist, and he's also very quantitative, and he's still alive. He's doing a lot of good research. But he said there are other factors that can influence the return of a stock, and this is where it gets very interesting. And this is basically, since about 2010, it's been picked up by a lot of large asset management firms, and it's basically taken over the industry to some extent. So these are some of the factors. So basically, a factor is any characteristic that can also explain the difference in an outperforming or underperforming stock other than beta, essentially. So, and we've talked about some of these previously. We have some strategies based on them as well. So for example, value. A company, does anybody here have an idea, how would you consider a company to be overvalued or undervalued? What are some metrics that you might use to make that determination?
Maybe the RSI.
Okay, interesting. That's definitely, that's a technical indicator that can be used to judge maybe that a stock that's overvalued would have a high RSI. In this context, it's focusing slightly more on company fundamentals. Does anybody have any ideas of like what fundamental metric that you might use to determine if a company is over or undervalued?
Well, you could take any financial price to book and compare it across the sector or across the stocks that are in the same class.
Mm-hmm. Okay, that's a very good suggestion, and that is one of the more commonly used value factors. So could you explain what is price to book ratio? What is that?
All right, so it's essentially the asset over the book value of the asset. So just combining all of the the assets, PP&E, intellectual property, I think. What else? Sales, cash, operating cash, etc., and just using that as a metric, as a ratio to oh, I'm getting another phone call. I'm sorry.
No, you're good.
But yeah, that's a basic gist of it. Jesus, how do I stop this?
No, you're fine.
Yeah, that's the gist of it. It's basically just taking all of the assets, all the liquid assets, I believe, and just taking that as the book value and just using that as a comparative metric.
Mm-hmm. So it's something that you can, it's sort of publicly available information. This is something you could easily write code to trade based on this. So on March 2nd, I presented a strategy that looked at price to earnings ratio, which is very similar to price to book ratio, but they're the same concept. You're basically looking at what's actually on the company's financial statements versus what does the market think that the company is worth. And if there's a big discrepancy, if the market thinks the company is worth way more than the assets on their financial statements or the revenue that they're generating, that would be a sign of an overvalued company. And I also said that the entire stock market was overvalued on March 2nd, which is interesting. So anyway, size is another very common factor. And this is something I didn't know until I was researching for this. It's very interesting. There's actually a significant difference in performance of a stock based on how big of a company it is. In other words, what is the market capitalization is. So does anybody have any theories? Like, let's say, do you think that a smaller company on average would have a higher or lower return compared to a larger company? Does anybody have any theories? So basically, we'll get into the details, but it turns out that small companies that may be overlooked by a lot of investors tend to perform a lot better. And so that is another factor that is used in factor investing. Volatility. So it almost seems like common sense, but stocks that are not extremely volatile tend to have a higher risk-adjusted return. And so you can comprise your portfolio of stocks based upon lower volatility. If the stocks that have lower volatility, you can add more of those to your portfolio, essentially. Momentum. Momentum is a very interesting factor in that it seems to have the highest alpha when implemented properly, but it also is the factor that seems to not have a direct reason why that it makes sense. But it seems to be the case that stocks that have performed well recently are more likely to perform well in the near future. And then finally, and this kind of goes back. Yeah, go ahead.
Yeah, I was just gonna say. I'm sorry. Wouldn't you say that all these factors, they'd be, to say that they have outperformance over, say for example, like the size, market cap.
Yeah.
Wouldn't that be on a scale basis? Like say like over, 2008, 2012, micro caps outperformed, large caps. But would it be like making these generalizations? Wouldn't it be good to point out like this again is on a time scale basis?
Yeah. So here,
like it's not overarching. Essentially,
I agree, and it's a very good point. Here is sort of an interesting chart I found that kind of sold me on it a lot more. So ever since Fama published his research, this company has been they read his paper and they sort of have been publishing this index ever since then. So this isn't even a back test. They basically start publishing this index based on his definition of sort of each of these factors. And you can see that, I'm not sure, at least on my screen, you can drag the video over here so you can see the right hand side, but regardless, sort of all of the factors outperform the general market index, and they do so to varying degrees, and that this has been true for about the last 25 years. But it may not continue to be true, and I'll talk more details on how crowded this space is getting recently. Quality, this is the one that's a little bit more proprietary. It's not very well defined, but it just basically higher quality companies tend to have a higher sort of profit ratio, which is also implemented in the example strategy from March 2nd. If you guys are curious on how a sort of factor investing model, what the code actually looks like, definitely check that out. And then there's like these three. So these are different type of factor called macro factors. I'm not going to talk about them in detail because they're sort of very self-explanatory. So this is like the famous three-factor model that Fama and French published together at first, and it's a very interesting sort of modification. So if you look at the equation for the three-factor model right here, like where it says ER equals, and you can see the first term, there's the beta sub I. So the beta is still being considered as a factor, but he's added sort of two additional factors. And this is kind of where it all started. So he added the value and size factor and saw sort of very significant outperformance that could be allocated to those factors. And an interesting thing about using multiple factors in your model is you can determine exactly which factors are causing a higher expected return. And so you can figure out why your strategy is outperforming. And he proved with this paper that it's not just because the beta of these stocks are higher, it's actually because of these other factors. And obviously you can take this same concept and create 50 factors if you wanted to, and figure out exactly how much each of those factors is contributing to your overall sort of expected return. So if you look at this graph here, the blue line, does anybody have any theories what the blue line represents in this chart? So the blue represents expected return. And if you look at the x-axis, one second, if you look at the x-axis of the chart, on the left side you have growth stocks, and on the right side you have value stocks. So growth stocks would be stocks like Google that have a very high price to earnings ratio. They're considered overvalued by the value factor. And you can see that those stocks have a lower expected return compared to value stocks. And if you look at the really important part of this chart, and this is what revolutionized academic, basically quantitative factor analysis in the first place, if you look at the red dotted line and the black solid line, those are the beta factors. And you can see that the beta factors are basically flat. So it's not that there's a higher beta with value stocks. It's actually almost exactly the same. And you can basically prove based on this that it is the value factor. This specific chart proves that the value factor causes an increased expected return over time. If that makes sense. Does anybody have any questions on that? Because I don't know if it's maybe too complicated.
So if we're choosing our portfolio, we should be looking out for the value factor instead of the beta factors.
Exactly. So if you're choosing a stock, this chart basically tells you that the beta is irrelevant information. It doesn't matter. But the value factor, which can basically be summarized as price to earnings ratio, which I talked about on March 2nd, that is actually what's causing the higher expected return, and this proves it, essentially. So that's exactly right, yeah. So applications of factor investing, and this is what's really interesting to me, is that this sort of development came from academia, and it did transition to industry, and it's become very popular. And a lot of times in quantitative finance specifically, you see industry kind of leading academia, but in this case, you do see some very good innovation coming from that side. Now, things have changed basically in the last decade. Now, this is like the really hot topic. This is being used by a lot of the big quant funds right now. And people are just desperate to find new factors that have alpha that are causing. So basically, there's been like 300 factors have been discovered, but so, people have done sort of summary studies of the field and found that most of them are really not necessary because their results are basically can be explained by the more basic factors. But it's still a very interesting thing, and coming up with a unique mix of factors could be a very powerful investment strategy. And there's so many advantages as well, because you don't really have to do active management. There's almost no overhead required. Like I was talking to a firm in Rochester, high probability advisors. I mean, you basically need like a skeleton crew of 10 people, and you can execute these strategies because you just have to check, literally like once or twice a month, make sure that you're balanced your portfolio appropriately given the factors. And it basically doesn't require, it can be automated very well because it's kind of simple in a way, and it doesn't require like active management, stock picking, equity research. It doesn't require any of that. It outperforms the index significantly, which is good. And as I said, it allows you to pinpoint where your alpha is coming from. And I think that's a critical thing. Even in other algorithmic strategies, it can be hard to know where is your alpha coming from, especially if your strategy doesn't make a lot of sense. It just works, but you don't know why. You don't know if it's where you're entering the market is where the edge is, or maybe it's where you're exiting, or maybe it's both, and that's really hard to pin down. And so that's kind of a unique advantage of this approach. Talking disadvantages, it's not market neutral, so it's always talking about what stocks to buy. So obviously, if the market collapses, you're not going to suffer as badly, maybe, but it's not a market neutral strategy. It's not something that's going to climb slowly no matter what happens. That's definitely not what it is, and that's the downside. And then, obviously the space is getting more crowded as well, and so it remains to be seen. I'm a little bit suspicious that these publicly available factors will stop working because of that, but we'll see. But you can see they're still working right now fairly well. And if you look at this chart, it's interesting to see which factors seem to do very well. So the momentum factor, for example, definitely outperforms. But there can be disadvantages to relying only upon one factor, obviously. Does anybody have any thoughts or questions so far about any of this?
Where can we get the chart they used?
This chart?
Yeah.
Let's see. I found it in a paper. I'll send it out. I found it in a paper, basically like an academic paper. Like, this is all graduate level stuff, but I'll send it out in the group chat immediately after.
Okay.
But yeah, there's a footnote on this chart that explains in detail as well, and it would definitely be something to look over how each of these factors are being calculated, and the fact that it's not a back test. It's been something that's been published since that time, which I thought was very compelling. And here is kind of a chart version as well. And this is very interesting, but it's a little bit hard to see what it means at first. So I definitely want to explain it. So we basically have like two sort of metrics that are being compared. So where it says like small, and then it says like 2, 3, 4 big on the left, that's referring to size. So big means like a very large company with a very large market capitalization. And if you read, I'll send the paper out. I think I cited it as well, but he defines exactly, what is a big company, what is a 4, what is a 3, based on market capitalization, which is extremely easy data to incorporate into Quantopian strategy, obviously. And then on the top, you have the book to market ratio. And so high book to market ratio means that the market isn't valuing it as much, and it has a lot of assets on the books that aren't affecting the stock price, which means it's a value stock, essentially. And on the left, you have growth stocks. So Google would be, a big growth stock. So it would be on the bottom left quadrant where it says 0.46. Versus on the top right would be companies you probably have never heard of because they're very small. They're kind of maybe some of the smaller companies listed on the exchange, essentially. So you may not have heard of them. And they're also kind of at a low price. But those, and the numbers are the monthly return. So sort of the highest value, 1.15, are small value stocks, and they return 1.15% per month on average. And if you compare that with something like a Google, it's 0.46%, and you can kind of see the ratio. So it's about 2.5 times better. And one thing my mind is thinking when looking at this is something called survivorship bias. So I was wondering if anybody doesn't really know what that means. I could definitely explain it, but has anybody heard the term survivorship bias before? So basically what that refers to is whenever you're conducting studies like this, you have to be careful about companies that go out of business. Are they included in your data set or not? And so I definitely believe these results, but I definitely want to investigate whether he had a universe of stocks that included companies that had gone bankrupt, because obviously these companies over here that are very small and very low price are probably more likely to go bankrupt than Google, and that's something to be considering. But overall, this could make a huge difference on the growth of your portfolio, even now, because now is one of the rare times where a lot of stocks are value stocks. usually it's very hard to find a large company at a low price, for example, or even a medium-sized company. There's a lot of value opportunities right now that you're almost never going to get. And so it's something to keep in mind. And here I'll quickly, these are some of the firms that are known to utilize factor investing. So BlackRock is probably one of the largest firms that they have a very large funds with, billions upon billions that all they do is utilize these strategies. Renaissance Technologies, it's hard to say, they're kind of a very mysterious firm, but most people believe that they're using proprietary factors in their funds. AQR Capital Management is another large fund that uses it. High Probability Advisors, so they're still looking, as far as I know, for someone this summer. I'm not sure how this is it's gonna be affected by the coronavirus, but like if you're interested in working, literally sitting right next to someone who does factor analysis all day and being an intern over there, I could definitely put you in touch with that guy because I've talked to him in person several times. So if you want to work over there, let me know. And then there's a lot of other companies that use it. So I'll just quickly summarize and let me know if you have any questions. But basically, there's some factors out there that can predict the market over long periods of time that academics have been publishing. And there's proponents who say that almost all outperforming managers are either intentionally or unintentionally using factor analysis. That was another study that I saw. And then just very quickly, I'll say that there's kind of a stock that's like the ideal stock for a factor analyst. And it would be a small company that's kind of undervalued. That's not a very volatile stock. Its price has been increasing recently so that it falls into the momentum factor. And it has like a low leverage ratio and a high profit ratio. That would be like the perfect stock according to this theory. I will stop here for now, but I may talk about automating a short-term discretionary strategy, which I think will also be very interesting. But I want to yield the floor to Wei. She has a very interesting presentation on sort of using time series databases in finance. So welcome, Wei. She's a quantitative analyst. Yep.
You can all start screen share while other. Okay. So. Oh, okay. Can everyone see the screen?
Yep.
Hello. Oh, okay. Today I'm going to present about introduction of the time series database and SQL usage. First of all, I think most of us all knows that the time series data is very important for stock analysis, financial analysis. So what is time series data? Here is the features. It is essentially a sequence of discrete time data that are commonly taken at successive equally spaced points in time. Notice that it is equally spaced points, and it has features that often integrate timestamps in the database storage, and often we use inserted more than updated for time series data in the database, and as new data is generated as time goes by, and so old data usually is not needed to be preserved after a certain time period. So we got the idea that time series data can be easily piled up along with the time, and so we have to figure out a way to get the database constantly renewed and delete the out of time data. example for the time series data, temperature reading from the sensor, the price of a stock, of course, and the status of a machine, or geographic analysis, and even number of the logins to an app, transactions of some commercial data. What is a time series database? I know that a time series database is extensively used in high frequency trading firms, and it is by nature a tuned relational database for time series data that can easily scale out and scale up. It is argued that relational database is not suited for time series data, for it cannot be easily scaled. And it is slower for inserting or something. So some experts tuned that relational database into like something fitted into time series data. Relational database I can list some, such as MySQL is the most known, and oh, I forgot the rest. Okay, fine. Time series database is faster than non-SQL databases, and a non-SQL database is frequently used by in older days, before this is invented. It is easier to scale up and scale out. For scaling up is like extended the volume on the same node, and scaling out is to extend the things that can be held for multiple nodes. So databases are all essentially tree structures, and so what makes non-SQL databases slower is of course also due to its tree structure. And we can use some like very handy tools for time series data analysis in all these time series databases. It provides automatic data retention policy. What is worth to mention is that that policy keeps like, for example, it keeps raw data and it rolls that into 15 minutes granularity for a month, for retention of a month, and it keeps the data for a day for data set needs aggregation like forever. Usually the data retention policy should be defined by users, but these databases provide the automatic feature of the retention. And for continuous query, I haven't figured out what is that, but I think that should be very powerful. And it has also has some access to the visualization tools such as Grafana, Tableau. Yeah. So it also has some APIs connected to Python and R. For the examples of the time series databases, the first one to notice is the KDB Plus. It is the world's fastest and most expensive, most well-known time series database. So the downside about it is it uses its signature SQL language named as KSQL. So someone argues that that KSQL is very different from the standard SQL, and takes a much longer time to learn about it. And there's a like substitution for KDB Plus, like invented by Chinese people. It's called Dolphin database. I used it before, but I found it's very hard to like download the Workbench for my laptop because I use Mac, and it uses the Linux system. So I think Dolphin database is like better tuned for Windows system. And there are also choices such as extensions for PostgreSQL. PostgreSQL is also a relational database. And these extensions, these plugins, I found two of them: pipeline database and timescale database. Okay. Oh, here are some like powerful features I found in timescale database for very good for analysis. Like you can see like median, moving average. I think what it makes it powerful is it can be connected to all these programming languages, and the forecasting packaging R is ready for use, and we can also use like sklearn features in the Python, so makes it a very handy tool. Next thing I want to introduce about SQL in case people don't know about it. The SQL is taught in DSC 261, like in UFR, and it can also be very easily for self-learners. So SQL language, it is called a structured query language by its full name, and it's designed to communicate with database. It is invented based on the relational algebra and in very old days. So it is very easy to learn and widely used. Here are some online resources for self-learning, WC schools, for official documentations, as we all know. And there's some like online course I recommend. It's called Introduction to Databases, offered by Stanford Online. Next, I want to introduce about commonly used SQL statements. So the first one, I cluster these like in their usages. The first one is wait. Oh no. The first one is to create table, if not exist, and inserting to update. Basically, these are features that we create table. We create the tables we need for the databases. Notice that we often use use what and appended by the database name in front of the select statements. And next, for select from, where, order by, these are the most common statements we would use for deriving data from the database. And for select, we append column names after select, and after from we declare the table names, and where we contain the conditions, selecting conditions for the columns, such as bigger than, smaller than a certain number, and we add order by after all these statements, and usually order by default is order by ascending order. So you can also define it to descending order. There are aggregation functions such as count. Count is to count all to count the number of the items in a certain column, and there's average, AVG, counting the average of the certain column, and there's sum, there's minimum, maximum. These are all aggregate functions. And following that, I want to mention the group by and having statement. These are often followed by the aggregation functions in the select statement. For group by, it is to show the rather than showing in columns, it show by specific groups, and having is the where statement for groups. So after that, I want to introduce the join statement. There are a lot of join statement. Join, left join, right join, for join. So I got a screenshot from WC School too. I think it's very expressive and informative in introducing the join statement. So the join statement by default is inner join in MySQL, I guess. So its full name is inner join. It gets the green very small part of the two table, like the the set that joined by the two table. And for left join, it takes the column set that is in the table one, and also like the shared features in the column in the table two. And there's a right join, like the vice versa of the left join, and there's also for join, which return all records when there is a match in either left or right table. We often like join things on a certain column, like column from this table equal to column from another table, and we use the on statement for this. There are also if and else statement in the SQL language. We use case, when, then, else, and end followed in the end to indicate the conditional selections of things. It is commonly used in the where statement with the parentheses, and usually we start with the case and then tab, and when to indicate the condition, then to indicate the following result, and then after we it's like if statement in Python, when, then, and else if in Python, and end is the very end of the case statement. Next, for creating database and drop database, we just use create database, drop database, followed by the database name. And for creating tables, we use this statement and followed by the table name, and also with the columns and the data type for the column. We use a drop table and followed by a table's name for dropping a table. There's also and or not statement, which is often used in the where statement for SQL language. And there are things to notice. Often when we finish a certain query, we should always use semicolon after that. And we should also know how to deal with null values in data cleaning, since SQL is very handy in data cleaning. I also recommend a like sort of extension feature for SQL, MySQL for Excel. So there's something called VS tool for Microsoft. It should be downloaded before the Microsoft for Excel. So after the data cleaning, it can be easily output to Excel files if you download this. So SQL accept the uses in all these database workbenches. It is used in Python, PHP, and HTML, I think. So here are a small example. So it is the statement for creating a table. So we first indicate, we create a table if it's not existed. So if it's existed, this statement is a dummy. So we first indicate the primary key, and then the column name followed by the data type, and then we set it to null. These are all column names, and we follow the query by a semicolon. These are adding some dummy values into that table. We can see that we are adding values corresponding to the column name, and we use the inserting into statement, inserting into the like database table name and all these column names, and all these values for the corresponding column names. These are for selecting value from the table that we created. So it's the database, it's the table name dot column name, and then we select these columns from a certain table, and order by is we order by these two. We use these two columns order in extending order to order the rows that shown in the table we created. Yeah, thank you. That's all. So I originally want to create a strategy using SQL to derive a trading strategy using SQL, but I think as I approach this project, I think it's too difficult for me right now. So I may present how to use SQL to derive strategy later on in my some other presentations.
Yeah, very good job. I kind of have a question, because Dominic and I are working in CSC 240 data mining, and we are trying to do just that. We're trying to create a strategy based on the level 2 order book. Do you know what are you familiar with level 2 order book at all?
Level 2 order book.
So yeah, basically it's a list of how many orders are at every single price level in the market, and so literally multiple times a second, we sort of have 50 different values at different price levels, how many orders there are, and it's basically just a massive data set. So we're probably going to use SQL for that. That's kind of what we're thinking, but it definitely seems more powerful than Excel, and you can program a very specific rule set. That seems to be the advantage.
Yeah. That's the end of my presentation.
Okay, all right, let me finish really quick. I have a very interesting strategy that is basically how do you go from a discretionary trading strategy to an algorithmic strategy using a support and resistance model. Let me really quick do this. What's up, guys? All right, let me share. So basically, the story with this is a lot of you guys are discretionary traders, and I want to help you guys get your strategies automated, essentially. So the code that I sent out in the email, if you guys pull it up, I think that would be a good idea, but it's certainly not necessary. But basically, this is a very English version, a very simple version of what this strategy is, and you'll notice that it's very similar to a lot of discretionary trading strategies that people are talking about right now. So this strategy says basically you buy at support, you buy at daily support, and so you place a pending buy order at the mid price of the last 6 hours, essentially. That's where you're going to place the buy order, and it's kind of adjusted. So if the market is more volatile, you'll sort of place it a little bit higher. But this is kind of similar to when a trader looks at a chart and says, okay, this is support, I would like to buy. How do you take that idea and convert it into a strategy? So this strategy holds for about 12.75 hours using the rules that are outlined in the text file on the email. It has an 89% yearly return with a 1.5 Sharpe ratio, and it holds on average for about 6.5 hours. So a very typical strategy. So if you came to me and said, I have a support and resistance strategy, how do I define support mathematically? That's the first question that I would sort of ask someone who had a strategy like that. Does anybody have any ideas? If someone tells you buy at support, how could you convert that to an algorithm, essentially? Because it seems subjective. Does anybody have any ideas how you could do that?
You could start prototyping it in Quantopian, perhaps.
Okay, that's a good idea. It definitely is something that experimentation would be helpful. Just messing around with maybe some of the indicators that exist, and trying to create a formula that defines this is what support means to me. However you choose to locate on the chart. Maybe it has something to do with what happened yesterday. Maybe yesterday's low support for your strategy. And so here you can see an example of the strategy entering the market. So what this strategy does is it mathematically calculates this support level. I'll show you the formula for that in a second. But instead of trader saying support, I have a mathematical formula for defining what support is. And so when price goes below support, what this strategy is programmed to do is wait 4 hours. After that 4 hours is up, it will start placing buy orders at this red line. And when price crosses that red line, it will enter into the market long. So you can see it happened sort of at a very, very good price, essentially. It's kind of circled in yellow there. And then it will hold for 12.75 hours and exit the position. Or if the stop loss is hit, and the stop loss is very small, it's kind of defined to be like 5 times the average amount of the price can move in 15 minutes. So it's a very small stop loss, and the strategy does very well just by following this rule set of basically buy at support and sell in 13 hours. It's a very simple strategy. So here's how I chose to define support mathematically. It's a little bit of a strict definition in that it doesn't happen extremely often, and it's something where you want to avoid putting your capital at risk unless it's a very good opportunity. So what this strategy says is we'll take the low of yesterday as support, but we don't want to buy at that price because that would be, it could be a good idea. But anyway, we're gonna go even lower, even a more favorable price, and it's basically 2 times this parentheses value. And what this parenthesis value is basically depends on volatility, because you can see high plus low plus close divided by 3. That's kind of like the average price of yesterday. So let me translate this to English. It's like the low minus yesterday's low minus yesterday's high minus the average price of yesterday. So you can see that the difference between high and the average price of yesterday will be larger. If the market was falling off of a cliff like it has been recently, that difference will be higher. And so that means that the strategy will do well even if the market is behaving strangely, because it kind of accounts for that in the formula. So that's kind of an example of how you could define support in a strategy. And does anybody have any questions about the formula or just the idea of the strategy in general, or just anything?
Zach?
Yeah.
Yeah, on the chart, were you using a pivot indicator to like mark your support levels?
That's correct. Yes, this formula that I'm presenting is similar to the formula used in the pivot point indicator.
Yeah.
But it's a little bit stricter. So this will not happen on a lot of days. It kind of requires a specific sequence of events to happen.
It's funny we're thinking the same, because I started using that to try and build something.
Good. Well,
anyway,
you're close. I mean, this is a very good strategy, and it's simple.
Yeah. Okay. All right. Thanks.
Yeah, no problem, dude. So yeah. So you buy kind of at this support level, but the key, there are a few differences that kind of separate it. You've got the 4-hour waiting period. There's a few twists that make this a very good strategy, essentially. It works very well on equities. And so basically this will guarantee you're not over trading because it requires a sequence of events to happen that are very good before you enter the market. It means you're going to be entering at a favorable price. It means you're going to have a stop loss and a short holding period, which both reduce risk. And the final comment I will make is that if the market's falling off the cliff, this strategy won't just buy into it because it requires a confirming price action, going back in your direction and crossing that sort of red line, which is calculated as the mid price of basically the last 6 hours. And so all of these things come together to create a strategy that's very robust and very effective in equities. So if you guys are interested in this strategy, definitely check out the source code, which I'll post on the shared drive. So this is the second strategy I'm releasing. It's one of my better strategies. So it's also been doing very well recently. But yeah, that is all I have. If anybody has any questions, definitely feel free to let me know.
Zach?
Yeah.
Yeah, could you please go back to the chart where you showed like the algo? Yeah, and could you please explain it again?
Yeah, absolutely. So yeah, for sure. So like this S3, the orange line, that'll be like sort of a mathematical value, and you know that value from the very first minute of the day. So that value will never change all day. It's always that value until the end of the day.
Okay.
And so if the price doesn't go below that during the day, nothing's going to happen. So the first thing that's required is, so you see there's that little spike below the support, and it happened kind of like 30% of the way through the day it happened, because you can see at the end of the day, it's like on the far right where the market's close. See that? So it's like 30% into the day, we have this spike below support. So that starts the 4-hour timer. So you can see that blue thing where it says 16 bars, 4 hours.
Yeah.
So for the next 4 hours, we're not going to do anything, but we know that we're going to be placing orders after that. So as soon as the 4 hours is up, we start placing buy stop orders. So pending buy orders essentially at the red line. The red line is essentially the mid price of the last 6 hours. And so what does that mean? What it basically translates to in English is you're waiting for confirming price action. So if the market's going straight down, you're not going to buy into it. You're going to have to wait until it comes back to some sort of average. So that's kind of like your safeguard against what's happening right now, in fact. And so you can see the price continues to drop aggressively because we're in a crazy bear market. So therefore it doesn't do anything. But it keeps every 15 minutes, it's going to move that order to the price of the red line. So it will once this condition is triggered, it may have 100 orders a day, just placing it, moving it, placing it, moving it. It's going to be moving all the time, every 15 minutes, until price eventually crosses that order. It will happen eventually.
When you say the red line, you mean the Ichimoku thing, right?
That's correct. Yeah. So the Ichimoku is kind of an indicator, but the red line specifically in that indicator is sort of the mid price of the last 6 hours. So that's why I described it like that. And so as soon as price crosses that, you buy, you wait 12.75 hours or until your stop loss is hit. Yeah. So it's a very interesting one. Yeah, go ahead, Kim.
Yeah, it is.
Yeah, I was asking, do you mean like from the 16 bars, from when it drops below the daily support, you start putting in orders, but you don't put them into the market. You wait until it hits the buy signal. So by that time, you would have accumulated like a lot of orders, and then when it hits the buy signal, that's when the orders are going to be executed. Or do you wait till? Does it accumulate orders till it reaches the buy signal, or does it wait till the buy signals hit?
Yeah, so it's kind of like this. No order will be placed, no orders placed until 4 hours after the buy signal. Does that make sense? So you see the buy signal is where that green arrow is. So the buy signal can only happen once a day, and it happens the first time that price goes below support. So as soon as 4 hours passes, then you start placing orders, not before then, if that makes sense.
Yeah.
I think his question is more on the lines of like, do you have a bunch of residual orders like sitting on the book from the point at which you start, placing them until you actually like where you have the yellow circle, right, is I imagine where you finally like enter because the price meets your orders. But then you have all these backlogged orders that like you might still get like filled on unless you cancel them, right?
Oh, okay. Good question. Thank you for clarifying.
Yeah.
So the answer is that the orders are modified and there's never more than one total open at any given point in time. However, I have sort of a parameter. It's called replace existing orders. So by default, that's set to true and those orders will be replaced. So there'll never be more than one and it will only enter at one point no matter what. But you could change that parameter without even changing the code and see if it performed better if you left all the orders open, and it would be a very different performance because that's a huge change to the strategy. But it would be interesting to see. I doubt it would be better because it would be very just orders everywhere, But good question. Good question. All right, thanks you guys so much for coming. This has been really good. Good job, Wei, with the presentation. Great job.
Yeah, Zach, I still have one more question.
Sure.
The indicators, like this indicator that we have here, is it from how do you implement it into TradingView?
Sure. So just type in, so the support formula is very similar to the pivots indicator. So pivots for that, and then in terms of the the mid price of the last 6 hours. One way to get that is by using the Ichimoku indicator. And basically just uncheck every single box except for the box that says 26, which is the Kijun Sen line essentially. So that's basically what that is. So does that kind of answer your question?
Yeah, I'll meet you later for it though.